for the test next week because the test will be next week. So let's get started here. So the Bank of Canada. So the moving force behind Canada's monetary policy is the Bank of Canada. It has served as Canada's central bank since 1935. Its principal role is to promote the economic and financial welfare of Canada as defined in the Bank of Canada Act. It's a wholly government-owned institution. Directors and governor are appointed by the federal cabinet. So the current governor is different now. It's Tiff Macklem. Stephen Poloz was the previous governor. So the Bank of Canada performs four basic functions. It manages the money supply, conducts monetary policy by controlling the amount of money circulating in the economy. Not only does it issue paper currency, but more importantly, it affects the activities of chartered banks and similar financial institutions, near banks, so that it can vary the supply of money and interest rates. The Bank of Canada performs four basic functions. Manage the money supply. So managing the money supply, the bank is concerned with three goals: minimizing inflation to preserve the purchasing power of the dollar, maintaining real output as close as possible to its potential level, regulating the external value of the Canadian dollar and foreign exchange markets. So it also acts as the banker's bank, holds deposits of members of the Canadian Payments Association, CPA, makes advances loans to CPA members at the bank rate. It acts as the federal government's fiscal agent, holds some of the government's bank deposits, clears the government's checks, handles the financing of the government's debt by issuing bonds, including Canada's savings bonds and treasury bills. So it issues the bonds used for governments to borrow. So it's a very important, it serves a very important purpose. Also, it prints money that the government can borrow from. So the government borrows from the printed money that the central bank provides, and also the central bank allows for the government to borrow from people like us and businesses through Canada savings bonds and treasury bills. They issue Canada savings bonds and treasury bills. We buy them. So we lend to the government through buying Canadian savings bonds and treasury bills. So it helps supervise the operations of financial markets to ensure the stability. The bank works in conjunction with the Office of the Superintendent of Financial Institutions and follows the global guidelines of the Basel Committee on Banking Supervision. The success of Canada's financial supervision has received considerable attention since the 2008 financial crisis. So active learning, which phrase best describes the Bank of Canada? Which of these phrases A, B, C, D, or E best describes Bank of Canada? So Christabel says B, so a government-owned central bank whose basic goal is to control the money supply and thereby help to promote general economic welfare. Yes, correct. Excellent job. Which of the following is not one of the four major functions of the Bank of Canada? So Christabel says A, manage the economy's supply of goods and services. Correct. Yes. So they don't do that. It's mostly focused on providing the government with credit, so allowing them to borrow from the market and allowing them to borrow, the government to borrow from the Bank of Canada. And it's mostly price stability that they focus on. So price stability and allowing the government to borrow. Canada in the financial crisis. Canadian financial institutions were less affected by the financial crisis than most industrialized countries. Why? So 2008 was the financial crisis where there was issues with the housing market in the United States and people couldn't pay back their mortgages. So why was Canada less affected by this? So Curtis says the Canadian banks were less risky. That's correct. Yeah, they have a better capital system. They didn't take on as much risk as the US banks. That's true. So good point. They weren't the Canadian banks weren't allowed to loan to high risk borrowers as much as the US. And then Christabel says because Bank of Canada has a good system and trust. Yes. So that's true. What about now? I'll ask you now. So what about now? Does the Canadian banking system uh does the Canadian banking system have the same level of risk now compared to 2008? Like are they in risky practices or not? Yeah, Christabel's right. It might have more risk now due to the COVID-19 response. Yes. So like a lot of the debt, more fluctuation. Yes. And also I think that the there's a lot of high risk loans right now. I think that the there's a lot of loans where the the housing price compared to income is just extremely high. So people aren't so with higher interest rates, they're not able to pay their mortgages very easily because of the lock their income compared to the housing prices. If if the house price is $1 million and they're making 100,000, having it 10 times income, that can become an issue. The housing prices compared to income, it's a big gap, so it's very hard to pay those off. So Canadian financial regulators have banned high-risk mortgage lending. So I would say that was true in 2008, but now they're getting more risky. They're lending to people that are their income is pretty low compared to the housing price. Canadian banks engage in far less risky behavior than many of the global counterparts in trading risky derivatives such as mortgage-backed securities. So back then, I think that was true, but now they're getting more risky because they're lending to higher risk borrowers. Canada's large banks have lower leverage ratios than many of their global counterparts. So I would say, so Christabel says, yeah, the government has done several risky moves like freezing bank accounts too. Yes. So I think yeah, the the situation now it's a lot more risky than it was. The I think that there it's just a lot more risky. The housing prices have went up way too much and incomes haven't changed a lot. The problem is median incomes haven't moved a lot over the past few decades while housing prices have gone up a lot. If you want a stable housing market, median incomes have to rise the same rate as housing prices, but that's not the case. The Canadian property market has not succumbed to the same bubble conditions as in some other countries. I think that that's different now. I think it's changing. I think that so Christabel says my brother was talking to me about it and that it lowered global trust in Canadian economy. Yes. So I agree. So we watched this video earlier in the semester and it was a very good video and it went through how the Canadian economy is really built on real estate and they haven't really focused on productivity. And that's not a sustainable trend because they need to be focusing on productivity and growing the amount of productivity we have per worker by investing in workers, but they've really just gone all in real estate and real estate doesn't doesn't improve productivity per worker. We're not improving productivity by focusing on real estate and it's unsustainable. So that's one of the biggest issues we have. While the US doesn't focus all on real estate, they focus on productivity very significantly more than we do. So that's one of the main structural issues we have, and that's going to have to be corrected if Canada wants to be competitive. So monetary policy. So monetary policy relates to how a country's central bank governs the supply of money and interest rates in the economy in order to influence output, employment, and prices. Recall that monetary policy involves the Bank of Canada changing interest rates, altering the money supply, or both to stabilize the economy. Our analysis of money and deposit takers allows us to examine the way in which monetary policy is conducted. Monetary policy can be broadly classified as either expansionary or contractionary. Expansionary monetary policy. When real output falls short of its potential level, a recessionary gap is created. The Bank of Canada will use an expansionary monetary policy to stimulate output and increase employment and close the gap. Such action is referred to informally as easy money policy, a policy of increasing the money supply and lowering interest rates. This shifts aggregate demand leftward by a magnified amount due to an initial a decrease in investment and the consumption of durable goods. Spending multiplier. The change in aggregate demand or total spending is found by calculating the product of the spending multiplier and the initial spending change. Total change in output shift in aggregate demand curve equals initial change in spending times spending multiplier. Suppose, for example, that the initial increase in investment and consumption totaled $9 billion and the value of the economy's spending multiplier is 1.67. So, yeah, so if you spent $9 billion in the economy, multiply that by 1.67, and that would create 15 billion in economic activity. The total change in aggregate demand is then $15 billion. So that's like when we talked about the spending multiplier, it's very important to show how much an investment will return to the economy. So so they look at that, government looks at that to determine where they should spend in a lot of cases. So here, in a recession, the bank can increase the money supply as shown by the shift from SM0 to SM1 on the left, thereby pushing down the interest rate, point A to point B. The result as a whole, due to the spending multiplier, is an increase in aggregate demand of $15 billion, 80 to 81 on the right. However, output does not rise by the entire $15 billion, i.e. point C to point E. Rather, the price level and output both rise to give a new equilibrium at point D, with output at the potential level of $800 billion and the recessionary gap eliminated. Contractionary monetary policy. When real output exceeds its potential level, an inflationary gap is created. Bank of Canada will use a contractionary monetary policy to reduce output and close the gap. Such action is referred to normally as tight monetary policy. Policy of decreasing the money supply and increasing interest rates. This shifts aggregate demand leftward by magnified amount due to an initial decrease in investment and the consumption of durable goods. During a boom, the bank can lower the money supply from SM0 to SM1, pushing up the interest rate point B to point A. Because of the initial spending decrease in the spending multiplier, the result is a decrease in aggregate demand, as shown on the right, as the $15 billion shift from 80 knot to 81. Output does not fall by $15 billion from point E to point C. Rather, the price level and output both fall to give a new equilibrium of point D, with output at the potential level of $800 billion and the inflationary gap eliminated. So, active learning. The tables show hypothetical money demand and supply schedules, as well as aggregate demand and aggregate supply schedules for an economy whose natural unemployment rate is estimated to be 7%. Suppose the unemployment rate is 8.5% and a declining rate of inflation. Is the economy facing a recessionary or inflationary gap? Should its central bank use a contractionary or expansionary monetary policy? So, so try to answer A. So Christmas is recessionary. Yes, because the Yes, recessionary contract, yes. Because the unemployment rate is above the natural rate of unemployment. So there will be cyclical unemployment here. So should we use an expansionary monetary policy or contractionary monetary policy? Oh, so Christabel did say that. So should we use contractionary? So we should use expansionary in this case because expansionary monetary policy will get us out of this recessionary gap. So if we use expansionary monetary policy through increasing the money supply slash reducing interest rates, that will help us get out of this recessionary gap. So we would want to raise the money supply slash reduce interest rates, and that will help. So I kind of answered the second one. So identify the steps by which this monetary policy will affect the economy. So yeah, so raising inflation is beneficial in the short run because in the short run it will create jobs. Yeah. In the long run, there's no effect, but in the short run, we can we can increase the money supply to get us out of the recession in the short run. So with high unemployment and falling inflation, the economy faces a recessionary gap. Therefore, an expansionary monetary policy should be used. With an expansionary monetary policy, the Bank of Canada purchases government bonds in order to raise banks' excess reserves. So to increase the money supply, the Bank of Canada purchases government bonds. That's how they do it. So they have to purchase bonds to increase the money supply. This results in the magnified rise in the money supply thanks to the working of the money multiplier. The increase in the money supply causes the equilibrium nominal interest rate to drop, which raises investment by businesses and consumption spending on durables by households. The spending increases, pushes up aggregate demand, and raises both equilibrium output and the price level. As the economy expands, the recessionary gap shrinks and the unemployment rate falls. So the tables show hypothetical money demand and supply schedules, as well as aggregate demand and aggregate supply schedules for an economy whose natural unemployment rate is estimated to be 7%. So I'll ask you, what is the equilibrium interest rate in the money market, and what are the initial equilibrium price level and real GDP? So don't worry about graphing it. Just answer the questions here. So the two at the bottom. So what's the initial equilibrium interest rate in the money market? So that will be quantity demanded equals quantity supplied, the interest rate when it's there. So here it would be, so to get that information, you would have to, so it would be 3% here because quantity demanded equals quantity supplied when the interest rate is 3%. And then the equilibrium price level in real GDP, that would be here. So it would have to be when these are equal here. Yeah, so that'd be the answer to that question there. And I'll put this in the chat here. So that's how you do that one there. Yeah, so that's how you do that. You would have to find out when the demand equals supply there. Yeah. So yeah, now that's in the chat there. So the initial equilibrium interest rate is 3%. It's found at the intersection of demand and supply here. So as you can see there, it's 3%. And that's when when the demand and supply equal each other. And then the initial equilibrium price level and real GDP of 120 and 300 billion are found at the intersection of 80 NOD and AS, point C in the second graph. So active learning, the tables show hypothetical money demand and supply schedules, as well as aggregate demand and aggregate supply schedules for an economy whose natural unemployment rate is estimated to be 7%. If the monetary policy applied in Part B leads to a $100 billion change in the money supply, then what is the new equilibrium interest rate? So if the money supply increases by $100 billion, what would the new interest rate be? So 2%, yes. So it should, so if there is an increase in the money supply, the interest rate will go down. Yes, so it would be 2%. Great job, Christabel. So yeah, 2%. So if you increase the money supply in this case, the interest rate would go down. As you can see here, the when you increase the money supply, the interest rate goes down. Yeah. So that graph shows the negative relationship between the two here. Because the monetary policy implemented is an expansionary one. The $100 billion change in the money supply is represented by a rightward shift from SM0 to SM1. The new equilibrium interest rate of 2% is found at the intersection of DM and SM1, point B in the graph. So yes, interest goes down, inflation goes up. That's correct. So because there's more money supply with a lower interest rate, so that will drive higher prices. Yes. So the tables show hypothetical money demand and supply schedules, as well as AD and AS schedules for an economy whose natural unemployment rate is estimated to be 7%. If the change in the interest rate in Part B causes a $200 billion change in real expenditures at every price level, then what are the new equilibrium price level and real GDP? So if so what would happen in this case? And you'd have to use the second table here. So if there's a $200 billion change from real expenditures, what would be the new equilibrium price level in real GDP? So it would be aggregate demand. So Christabel says 130. Yes, so you're correct. So real GDP would be so price level would be 130 and real GDP would be 400 billion there. So it would be yeah, so it'd be 130 and 400 billion here. So as you can see by this graph, so good job. This is what would happen here. So open market operations are a tool that the Bank of Canada uses to conduct monetary policy on a day-to-day basis. A sale of bonds by the Bank of Canada lowers members' deposit liabilities and reserves, which causes a magnified decrease in the money supply using the money multiplier. A purchase of bonds by the Bank of Canada raises a member's deposit liabilities and reserves, which causes a magnified increase in the money supply using the money multiplier. So bond sale. So when the Bank of Canada sells a bond to bondholder A, its bond assets fall, as do its deposit liabilities to Scotiabank. Meanwhile, Scotiabank's cash assets of the Bank of Canada decrease, as do its deposit liabilities to bondholder A. The drop in bondholder A's deposit immediately reduces the money supply by $1,000. With a reserve ratio of 10%, Scotiabank's excess reserves fall by $900, and the money multiplier is a value of 10. So they, in this case, Scotiabank would get that deposit and they would have to put 10% of that in reserves to the Bank of Canada and then lend out the other 90%. So that's usually what happens. So because reductions to deposits are magnified, the money supply drops as much as an extra $9,000. The $900 decrease in excess reserves multiplied by the money multiplier. So normally they would just lend out 90% of the $1,000 and then deposit 10% of the $1,000 at the Bank of Canada. So they would have to keep 10% of it at the Bank of Canada in reserves, and then they could lend out the other 90%. So that's usually what happens for the banking system. So they got to keep about 10% in reserves while they lend out that extra 90%. So the Bank of Canada purchased a bond from bondholder B. The bond assets rise and deposit liabilities to TD Bank. From TD Bank's perspective, its cash assets to the Bank of Canada increases due to its deposit liabilities to bondholder B. New deposit from bondholder B immediately adds $1,000 to the money supply. With a reserve ratio of 0.10, TD Bank's excess reserves increased by $900, while the money multiplier is a value of 10. Because deposits expand, the money supply increases by as much as the extra $9,000. The $900 increase in excess reserves multiplied by the money multiplier. So open market operations expand the money supply. Below is a sequence of events when the central bank uses open market operations to expand the money supply. So Bank of Canada buys a bond from private bondholder A. Check is deposited to the commercial bank. Check is presented for payment to the Bank of Canada. Increased reserves are lent out. So that's how it works. Then they usually lend out about 90% and keep 10% in reserves. Money supply increases. So active learning. The Bank of Canada buys a $10,000 bond from a member of the public when the reserve ratio in the banking system is 5%. Outline the effects on this bond purchase on each of the following variables. The bond seller's bank deposit, desired reserves at the bond seller's bank, excess reserves at the bond seller's bank, and the maximum change in the money supply. So Christabel's reserves are 5%, 500. Yes, so the bond seller's deposit increased by $10,000. The bank's desired reserves rise by $500. Yes. So what about excess reserves? Yes, 9,500. Excellent. And then what about the maximum change in the money supply? What would be the maximum change in the money supply here? So Curtis got $200,000. Yes. So yeah, 1 divided by 0.05 times 10,000. That would be 200,000. Excellent job. So yeah, that's how you do that because the 1 divided by 0.05 would be money multiplier. Yeah. Good job. So yeah, 9,500 here, excess reserves. And then the maximum increase in money supply is $200,000. So to do that, you would take you would do, so you take 9,500 times 1 divided by 0.05. Yeah. Um, and there you get about 190,000, but you can add that to the 10,000, you get 200,000. So commercial banks routinely borrow and lend money overnight. So actually, I'll take a screenshot of this and put this in the chat here. So I'll put this in here. Targeting the overnight interest rate. So commercial banks routinely borrow and lend money overnight among themselves in order to cover the net shortfalls or surpluses from transactions during the day. At the end of the day, they need to settle with each other. One bank may have funds left over while another bank may need money. This creates a market for short-term loans and the market price of the overnight interest rate. Bank of Canada's key policy interest rate. 8 times a year, the Bank of Canada announces its overnight target rate and then ensures it stays within a publicized range of 50 basis points, which equals 0.5%. The target overnight rate is the rate at the midpoint of this range. The Bank of Canada keeps the overnight rate near the target overnight rate by using 201 open market operations. Targeting the overnight rate is 2.75%. The bank rate is the rate that commercial banks pay to the Bank of Canada on loans to cover shortfall in reserves. Target for the overnight rates. Then the banker's deposit rate is the rate that Bank of Canada pays the commercial banks on deposits of excess reserves. So the prime interest rate, the bank rate, the overnight target rate, and the overnight lending rate in Canada 1988 to 2016. So it's run in been almost, it's been when one goes up, one goes down, they all move in the same direction. So the Bank of Canada's decisions with all these rates are pretty much the same. So they they usually set the prime interest rate. If they change the prime interest rate, the overnight lending rate, bank rate, and overnight target rate, all of them change. So yeah, when they change the bank rate, the rest of them change. Targeting the overnight rates. Changing the target overnight rate is a tool the Bank of Canada uses to signify its monetary policy intentions. When the Bank of Canada changes its target band for the overnight rate, it also automatically adjusts the bank rate since this rate is at the top end of the target band. Why do we care? The rate is a signal. A rise in the target overnight rate signifies a contractionary policy. A fall in the target overnight rate signifies an expansionary policy. If the change in the target overnight rate is substantial, then banks and other deposit takers also adjust their prime rate, which is the lowest possible rate charged on loans to their best corporate customers. The interest rate is the price of credit. The lower the price, the cheaper it is for businesses to borrow and invest, and for consumers to borrow and purchase big ticket items like cars and durable goods. Hence, lower interest rates stimulate the economy, and higher interest rates slow the economy get down. So types of inflation. There are two main types of inflation. Demand pull inflation occurs as rightward shifts in the aggregate demand curve pull up prices. So demand pull inflation is due to consumers demanding products more, and that drives up the price. Cost push inflation occurs as leftward shifts in the aggregate supply curve push up prices. So it's usually due to the price of inputs rising. So for example, if the price of chips for computers rises, then prices of computers will rise. So that's cost push inflation is input price rising because of, let's say, shortages, etc. And then demand pull inflation is due to higher demand driving up prices. So here, during expansionary times, aggregate demand increases shown by a shift of the aggregate demand curve from 80 naught to 81. People are demanding more products and services. The result is that price level rises from point A to point B. In other words, increased demand pulls up prices. The Phillips curve. So the Phillips curve is a graph showing the assumed inverse relationship between unemployment and inflation, the two economic evils. From 1960 to 1972, the Canadian Phillips curve was relatively stable. From 1973 to 1982, the Canadian Phillips curve shifted rightward, resulting in stagflation. From 1983 to 2013, stagflation was reversed, but no constant Phillips curve emerged. So the Phillips curve expresses the Keynesian belief in the fixed and predictable inverse relationship between unemployment and inflation that occurs with demand pull inflation, but not cost push inflation. When the economy moves from point B to point A, which may happen as a result of expansionary stabilization policies, inflation increases and unemployment decreases. So they can use rate rises in inflation in the short run to reduce unemployment rate. So in the short run, that can be a good thing to do. And the government does this through the Bank of Canada. So they lower the interest rate, raise the money supply to raise the inflation rate, and this may reduce the unemployment rate. So short run, I'll write this down. Short run, Bank of Canada reduces the interest rate. So reduces money supply, increases the inflation rate, and then reduces the unemployment rate. So the short run solution doesn't work in long run. So Phillips curve. So Phillips curve is important for that. And they base a lot of policy on this. So the Bank of Canada's policy is a lot based on the Phillips curve. So whatever the Bank of Canada is doing is pretty much related to the Phillips curve altogether. So in contrast, contractionary policies cause the economy to move from point B to point C. So yeah, so with contractionary policies, so the contractionary policies, Bank of Canada increases the interest rate, reduces the money supply. This then reduces the inflation rate and increases the unemployment rate. So they did this in 2021, 2022 to reduce inflation and improve affordability. So they use the Phillips curve. They use the Phillips curve to shape their policy from 2021 to 2022. So it's a very valuable thing for the Bank of Canada. They use this all the time. The shifts in the Phillips curve. So it's not always perfect, but it's a pretty good method for short-term Bank of Canada policy. It's pretty effective. It's a pretty great graph for the short run. But in the long run, like we said, this doesn't matter. Like inflation and unemployment have no relationship in the long run. But in the short run, you can use them. You can use this relationship. So during 1960 to 1972, inflation and unemployment stayed in a broad band from which the Phillips curve can be drawn, showed as a solid line. In the period from 1973 to 1982, the predictable relationship broke down. However, it seems that the Phillips curve moved to the right, shown as a dashed line, as both inflation rates and unemployment rates were above those of the previous period. In the period from 1983 to 2013, the trend was to lower inflation, but unemployment rates remained high until just before the 2008-2009 recession. As a result, the new position of the Phillips curve is not clear. Cost push inflation. So increased input prices cause businesses to decrease output. The resulting decrease in aggregate supply means a shift in the aggregate supply curve from AS0 to AS1. The result is that prices increase from point D to point C. Increased costs push up prices while reducing total output. This bad combo of rising unemployment and inflation is called stagflation. So high inflation is called stagflation, and it leads to potential unemployment. So the Phillips curve doesn't work if inflation's too high. The self-stabilizing economy. In theory, the economy has a self-stabilizing tendency due to long-run movements in the AS curve. If equilibrium real output is above potential output, then higher wages gradually push the AS curve leftward and decrease equilibrium output. If equilibrium real output is below potential output, then lower wages gradually push the AS curve rightward and increase equilibrium output. At point B, the economy could remain indefinitely as its potential output. However, when equilibrium is at point C in a boom, the economy's self-stabilizing tendency will push the S curve to the left so that potential output can be resumed. Similarly, if equilibrium is at point A in a recession, the self-stabilizing tendency will push the AS curve to the right. The long-run aggregate supply curve, these movements mean that the vertical line of the graph at the potential output level can be interpreted in the economy as the long-run aggregate supply curve LAS. This is because it shows all points consistent with stable equilibrium in the long run. However, in real life, the economy never gets a chance to settle in the long run stable state. Instead, it is constantly being agitated by changes in prices, technologies, taxes, demographics, etc., and therefore fluctuates between expansion and contraction in what is known as the business cycle. So Bank of Canada manages the supply with the main goals of controlling inflation and stabilizing the economy near potential output. Bank of Canada will use contractionary type monetary policy to reduce inflationary output gap. This has the effect of raising interest rates, reducing borrowing for investment and consumption, and shifting the aggregate demand curve left. The Bank of Canada will use expansionary loose monetary policy to reduce the recessionary output gap. This has the effect of reducing interest rates, increasing borrowing for investment, and consumption, shifting the aggregate demand curve right. The Bank of Canada conducts monetary policy through open market operations, buying and selling government bonds, and targeting the overnight rate at which banks borrow and lend excess reserves from one another. There are two sources of inflation: demand pull and cost push. In theory, there's an inverse relationship between inflation and unemployment. If the Bank of Canada tries to reduce inflation, it can lead to higher unemployment. However, the relationship doesn't always hold. Monetary and fiscal policy analysis. So instructions. So this lesson will present policy examples. You will identify the policies as fiscal, done by the government, or monetary, done by the Federal Reserve. If fiscal is taxing or spending, if monetary is it increasing or decreasing the money supply, is demand side or supply side, what economic goals is it targeting? So policy example 1, voters in Wayne County, Michigan approve a government plan to levy a special tax to pay for a new stadium for the local MLS team. Is this monetary or fiscal policy? So this would be fiscal policy because it's taxation. And then this policy is a fiscal policy. What area is it first going to affect? Taxing, excellent job. Is the policy targeted at the demand side or the supply side of the economy? So demand side is focused on businesses, supply side is focused on people. So it'd be supply side here. So it's going to be supply side. So it'll be supply side because the it's focused on the people. The so it's a tax on the people. So a special tax on the voters in Wayne County, Michigan. So it'll be supply side because it's a tax on the voters, so it's on individuals. Yeah. So which economic goal is this policy most likely to target? So correct, economic growth is the main goal. It will also help full employment because there will be people employed by the team, so that the players, people that work for the team, etc. So that's part of it too. So I would accept economic growth and full employment. Price stability, I wouldn't accept because the economic growth may cause price instability. So explanation, this is a fiscal policy that affects both taxing and spending. So taxing first, then spending. So you tax first and spend. It first is a specific tax for an infrastructure upgrade, building a football/soccer stadium. The money from this new tax will be spent on helping to pay for that building, that stadium. This is a subsidy, therefore it is supply side policy. So it's taxing individuals. So special tax on voters, so it's supply side. The idea behind public financing of stadiums is that will draw consumers and new businesses to that region, and that increased economic activity will fuel economic growth, which will then fuel more tax revenue. In reality, the economic growth and increased tax revenue rarely recovers the cost of public spending. So policy example 2, the Federal Reserve observes inflation of 8% over a period of 6 months. They increase the interest rate/discount rate in response. So is this a monetary policy or fiscal policy? So monetary policy, yes. So this is a monetary policy. Is it more likely to increase the money supply or decrease the money supply? So decrease the money supply because higher interest rates will decrease the money supply. And that's key for bringing down inflation. So is this policy targeted at the demand side or supply side of the economy? So it would be both because you want to bring down prices for businesses and people. So both of them, it's focused on both of them because you can bring down prices in both areas. Which economic goal is the policy most likely to target? Price stability, yes. Explanation. This is a monetary policy intended to decrease the money supply in response to inflation. By increasing the discount rate, the Federal Reserve is increasing the price of borrowing. This will reduce the demand for loans, hopefully reducing spending by both households and businesses. This expected decrease in aggregate demand will likely lead to less inflation. This is a long-run solution, though, so often the effects aren't felt for many months. I would say it's more medium run. It just takes a while for it to set in, possibly even a year or more. As of May of 2023, the Federal Reserve has raised interest rates to the highest level in 40 years in an effort to combat inflation. So the United States government decreases taxes for individuals and corporations earning over $500,000 per year. Is this monetary policy or fiscal policy? So fiscal policy, yes. This policy is a fiscal policy. What areas it's going to affect? Taxing. Yes, it'll be taxing. Yeah. Is this policy targeted at the demand side or the supply side of the economy? So I would say both. I would say it is both because it's targeted towards businesses and individuals. So as they said, if we go back here, the we go back, it's taxes for individuals and corporations. So corporations that'd be demand side, and then supply side would be individuals. So it would be both, I would say. But if you answered either, you'd be correct too. So yeah, so I would accept all the answers here. So which economic goal is this policy most likely to target? So economic growth is what they're focusing on for this, reducing taxes to grow the economy. So explanation, this is a fiscal policy that became popular in the 1980s. The intention was to target the supply side of the economy. The logic behind it was that if corporations, the highest earners, paid less taxes, they would then reinvest that money in new or expanded businesses and higher wages for workers. This would in turn create economic growth. This was and remains a controversial policy. Most of the savings from the less taxes when accrued as income and wealth increases to the top 1% of the US. Wages have not increased at the same rate as productivity, nor have they kept up with inflation since the 1980s. So it didn't end up working in the United States, this policy, unfortunately here. So policy example 4, the state of Michigan passes a law that says that they will pay for trade school. Yeah, so it ended up not working. It sounds like it makes sense, but if we look at the data, it just doesn't work. Yeah, so the experiment, it just didn't work. Yeah, agreed, Christabel. So policy example 4, the state of Michigan passes a law that says they will pay for trade school for anyone who is accepted. Trade schools are places where people can learn a trade. Examples of trades are electrician, plumbing, welding, HVAC, carpentry, auto mechanic, etc. So is this monetary or fiscal policy? So this would be fiscal policy here. So it's fiscal policy because it's focused on creating education programs. So this would be school funding. So spending on education, it would be government spending on education. So it would be under fiscal policy. So that'd be government spending on education. So this policy is fiscal policy. What area is it going to first affect? So spending, it'll be focused on spending. So it's a spending policy on education. Yes. So is this policy targeted at the demand side or the supply side of the economy? So it would be supply side because it's focused on educating individuals, not businesses. So since it's individuals, it'd be supply side. And which economic goal is this policy most likely to target? So this one I would accept full employment and economic growth. I would accept both answers because it does benefit employment because you have skilled workers, and also it provides for more productivity because skilled trades, more productivity because those skills are very valuable. So I would recommend, like I would say that full employment and economic growth are correct. Price stability it wouldn't help that because it's probably going to cause a lot of economic growth, which may cause inflation. So explanation, this is a fiscal policy targeting the supply side of the economy. It's targeting the goal of full employment. Remember, in a labor market, the workers on the supply side, the workers are offering their time, skill, and labor for sale at a price wages. The businesses are on the demand side. They need to purchase labor to produce their goods and services. In this case, the government is trying to increase the number of skilled laborers. The idea is that if people have more skills, they're more likely to. So, so what are the two big economic questions discussed in week one? So I'll post the link here. So if you go to the week one content in Fanshawe online. So supply and demand, what is economics and the economic problem? Yes. Excellent. So yeah, I'll give it another minute. Excellent. How does the economic way of thinking influence economics as a social science and policy tool? So it puts things in a more logical and data trend based mindset to make financial decisions, correct? Cost benefit analysis? Yes. So also, it's useful as a way to determine policy for governments. Excellent. And then what is the economic problem discussed in week one? So the economic problem stems from the tension between unlimited wants and limited resources. Yes. Production opportunity costs. Yes. So there's a lot of choices we have to make. So that's great. The influence of incentives. Yes, that's another good part of it. Yes. And then what is the concept of production possibilities and opportunity costs? So the PPC helps us visualize trade-offs, while opportunity cost guides decision makers by assessing the benefits lost when choosing one alternative over another. Yes. Getting the maximum production for each party, as some countries are better suited to certain productions than others. Balancing this maximizes both productions, correct? Maximum output levels of two goods that can produce with the given resources. Excellent. So how can resources be used efficiently for economic growth? So we got specialization, getting the most amount of profit from the least amount of resources. Excellent. Resource efficiency contributes to economic growth by minimizing waste, enhancing productivity, and promoting sustainable practices. Excellent. So, what are the benefits of economic coordination and gains from trade? So, specialization, when countries specialize in producing certain goods, they can achieve economies of scale, reduce costs, and enhance productivity. Yes. Theoretically, everyone can reach their maximum production potential and trade to compensate for other things they don't make for less. Yes. It's best to specialize in one area instead of trying to do everything. Yeah, it's best to specialize in what you're good at than not do everything. Yeah. Increase variety and quality of goods and services. Yes. Excellent. So how do demand and supply influence markets and prices? So prices go down when demand is low and supply is high and vice versa. Yes. Excellent. High demand equals high price. Low demand equals low price. Yes. When supply equals demand, when supply exceeds demand, prices tend to fall. Producers compete to sell their goods, leading to lower prices. Conversely, when demand exceeds supply, prices tend to rise. So consumers compete for limited resources. Excellent. So, what is market equilibrium and how can changes in prices and quantity be predicted? So market equilibrium is when demand equals supply. Supply can be changed through changes in technology and worker productivity. Demand can be changed through a higher amount of bidding for goods. Yeah. Market equilibrium occurs at the intersection of the supply and demand curves, where the quantity demanded equals quantity supplied. Yes. Market equilibrium is the balance between price and supply that will bring the most profit to a business. Changes in price and quantity can be predicted by looking at trends and extra spending money. Excellent. Then what is the role of aggregate supply and aggregate demand in economics? So aggregate supply refers to the total quantity of output, real GDP that firms are willing to produce and sell in an economy. Aggregate demand represents total spending in domestic goods such services. Helps explain the equilibrium in terms of real GDP and price level. Yes, that's true. So wait another minute. So how is gross domestic product GDP? Okay, that's okay. Um, how is gross domestic product GDP measured and what are its uses and limitations? So GDP is measured by government spending plus investment plus consumption plus net exports. Its uses are to determine how the economy is doing. Its limitations are that it doesn't adjust for median per person. So that's correct. There's other answers to other stuff there that you can add to. GDP is all goods slash services final market values within a certain time. Limited cause of legal activity as well, it doesn't count. Yes, that's a good point. So illegal activity isn't added, which is a downside. You can't measure underground activity, which is an issue. And it's very hard to yeah, it's very hard to figure that out. Yeah. So what are the concepts of employment and unemployment discussed in week 4? So yeah, unemployment rate does not include certain things and thus is not wholly representative of the actual employment of the population. That's correct. So yeah, so unemployment is actively seeking work within last 4 weeks and doesn't include people who have given up, which is a limitation. Yeah. How is inflation and deflation related to the price level? So prices must increase faster if inflation increases. Yes. So yeah. And how are the basics of economic growth and what are the basics of economic growth and how does potential GDP grow? So factors affecting potential GDP growth are labor force, population growth, participation rates, capital accumulation, investment in physical and human capital, technological advancements, innovations. Yes. Economic growth is related to the production level of the country. GDP grows when individuals' average production increases. Yes. So let's take a 10-minute break and then we'll continue with this. And then so this will be like, we'll finish this off. And then that will be the class. But let's take a 10-minute break and I'll see how about we meet back at 5:42 and then we'll finish this off. And that'll be, yeah. Okay, so we're back. So yeah, we got so the why does labor productivity grow and what are the theories, evidence, policy related growth? It grows as individuals can produce more goods more efficiently thanks to technology innovation, and this allows GDP to continually grow. Although I'm not sure that there's a plateau this can reach. Yes, that's a good point. There's really, yeah. So factors affecting potential GDP growth, labor force, population growth, and participation rates. Oh yeah, that was the answer for last time. So, labor productivity can grow through training, education, technology, and investment in capital per worker. So those are ways it can grow. What are expenditure multipliers and how do they relate to the Keynesian model? So expenditure multipliers show how much return on investment will be achieved with government spending and investment. It shows which investments will provide the highest return. Huh. And how do financial institutions and financial markets influence finance, saving, and investment? So they can raise or lower interest rates, lend more money, create tax-free accounts. Yes. Banks, credit unions, and other financial institutions provide a platform for individuals and businesses to access funds. They facilitate borrowing, lending, and managing money. Yes. So, what is the role of the loanable funds market and government in those markets? So, loanable funds help jumpstart businesses in faith that they will be paid back with interest. The government makes sure things don't get out of hand. Yes. And also business budget surplus, when the government collects more revenue than it spends, it acts as a supplier of loanable funds. Budget deficit, if the government spends more than it collects, it needs more funds. Yes. So how does the banking system create money and what is the quantity theory of money? So according to the quantity theory of money, the general price level of goods and services is proportional to the money supply in an economy. The banking system can literally create money through the process of making loans. Banking system creates more money by printing more to increase money pool and keeps more to reduce money pool. Theoretically, having more money in the money pool reduces value. Yes. Yeah. So more of something leads to a decrease in the value. So what is the exchange rate and how does it influence the balance of payments? So trade balance exchange rates affect a country's export competitiveness. A weaker currency makes exports cheaper and imports costlier, potentially improving the trade balance. Capital flows, exchange rates impact foreign investment. A stronger currency attracts foreign capital, while a weaker currency encourages capital outflows. Exchange rate is how much one currency is worth compared to another. So one country might have to pay more to import a product if their money is worth less. Yes. And yeah, correct. And then currency depreciation, a sudden drop in the exchange rate can lead to capital flight, affecting the financial account. Also, currency depreciation can lead to more exports because exports are cheaper for other countries to buy. So that's correct. And then currency appreciation can lead to more imports because the currency can buy more things outside of the nation. So how do global markets work and what are the international trade restrictions? So globalization refers to the integration of the world's economies, politics, and cultures. It involves stretching of economic, political, and social relationships across space and time. Yes. And trade restrictions or tariffs, taxes on imported goods, raising their relative prices, quotas, limits on the quantity of specific goods that can be imported, licenses or requirements for permits to import. Global markets are generally predetermined at this point as countries continue to produce their specialized products, but can change some. Some countries have restrictions though if they've been bad. So yes, so there are so a lot of countries that are bad actors, they can get restrictions. So sanctions are applied to countries that are bad in the world. So that does happen. So what is the case against protectionism and international trade policy? So encouragement to inefficient industries. Protectionism can prop up industries that are inefficient or not viable. Instead of relying on protection, other direct means could achieve the same objectives. So a lot of the time, protectionism is used to protect industries that are going obsolete, which is an issue. Also, reduce choice. Protectionism limits the variety and quantity of goods and services available to consumers by restricting imports. Consumers have fewer options, potentially leading to higher prices. Protectionism is a very restrictive policy that can deter other countries exporting to your country. Some people would rather have cheaper products than homegrown. Yes. So, how does the federal budget influence fiscal policy, and what are the supply side effects of fiscal policy? So supply side fiscal policy includes measures such as lowering corporate taxes. This boosts firms' net profitability, encouraging capital formation, increasing profitability, productivity. Investment in research and development (R&D), stimulating productivity leads to long-term economic growth. Lowering capital gains taxes encourages saving and investment and for improving capital formation. The Fed budget can influence things like inflation and interest rate, thus changing the landscape for the taxes, loans, and predicting the business landscape. Correct. And then fiscal policy refers to the use of the government budget to affect the economy, involves government spending and levied taxes. So, what are the objectives and framework of monetary policy, and how is it conducted? Mhm. Mhm. The monetary policy objectives and to keep the economy stable and growing through changes in policy depending on the situation, changes from year to year to try to balance everything. Yes. So monetary policy aims to balance price stability, economic growth, and financial stability. It's conducted through interest rate, reserve requirement, money supply changes. Yes. And then what is the role of monetary policy transmission and extraordinary monetary stimulus? So the monetary policy transmission mechanism ensures that central bank decisions impact the economy. An extraordinary monetary stimulus helps stabilize and support economic recovery during recessions. So MP transmission allows changes to flow with the economic status in relatively real time. Extraordinary monetary stimulus helps in the short term to keep people afloat. This can be recovered after. Excellent. How does inflation and unemployment relate to the Phillips curve in the business cycle? Expansion phase, low unemployment, higher inflation, moving along the short run Phillips curve. Recession phase, higher unemployment, lower inflation, moving along the short run Phillips curve. The Phillips curve describes how lower or higher inflation rates related to employment rates. It helps determine whether we use contractionary or expansionary policies.